I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's show is Jeff Assaf, the founder and chief investment officer of ICG Advisors, where he oversees $7 billion in assets for a highly curated group of 80 client families. While Jeff keeps his client names confidential, ICG manages money for a roster of successful athletes, entertainers, and business professionals with a combination of tailored investment solutions and white glove service. Many of those clients he's served for decades. Our conversation covers Jeff's path to investment allocation through Oppenheimer, Stearns, and eventually ICG. We discuss defining client objectives, selecting managers, building low-volatility portfolios, assessing re-ups in private equity, and serving as a good partner to managers and clients.
Before we get going, as I'm sharing this week's clip, you might notice my voice sounds a little different. This time, it's not our good friend Fake Ted, the AI version of my voice. Instead, it turns out I've been knocked out all week by our little enemy called COVID. 4 years ago, COVID knocked out our economy and familiar lives. Fortunately, this time, it just took me down for the count. I had it before, I've been vaccinated twice, and still, I got whacked worse this time around. When you're weary and tired, there isn't a whole lot you can do that's productive. And I definitely don't recommend giving a try to what I'm about to say. But if you do find yourself afflicted with COVID, yeah, you probably know where I'm going with this. I'll say it anyway. There's no better time to close your eyes and do nothing but listen to the soothing sounds of the Capital Allocators podcast. By the time you hear this, I imagine my voice will be back to full throttle, and this will all be but a happy memory. At least the listening to podcasts part of it. Thanks so much for spreading the word about Capital Allocators to your friends dealing with COVID.
Please enjoy my conversation with Jeff Assaf. Jeff, great to see you.
Thanks, Ted. It's great to see you.
Why don't you take me back to how you first got in the business?
When I finished business school, which was 1984, my economics professor kind of became my unofficial advisor. And I didn't know what I wanted to do, which is actually why I went to business school. So now I'm finishing business school. I still don't know what I want to do. And I asked my econ professor, what do you think I should do? And he said, you should go to New York and work for one of the money center banks. They have these MBA training programs and do one of them. They're all comparable. They're all good because it'll give you some training and you might get some ideas. So I applied to, I don't remember how many, and had plenty of offers. And I purposely chose the program. It wasn't the highest paying one, although they were all within a few grand of each other. It was the shortest program. It was a 4-month program. Okay, that's good enough. So I took it. I come to New York, August of 1984. It's hot, it's humid, it's gross. The city was not great back then. It wasn't my cup of tea, but that's fine. Like I had a buddy who did the same thing. He was at UCLA. I went to SC. He was a fraternity brother. He came to New York. He went to a different money center bank. But his job when he finished training was in LA. My job when I finished training was in New York. I cannot now start a job here. And I don't like New York. I don't like big money center banks and being a credit analyst. And I don't like the bureaucracy. This is not good. I'm going to have to just quit. I told my dad. And my dad's like, I did not pay for you to go to business school to quit after 4 months. And my dad had his same job at his company for his entire career. He started as an engineer, ended as president, did the whole ascent. So he was of that culture. Could probably use more of that today. But anyhow, so when he was away on a trip in London, I quit. I'm talking to one of my other fraternity brothers who was a broker at what was Shearson at the time. He had been a broker for a year or two, and he was making 8 times. And he said, you should go into the investment business. I'm good at it, and you'd be better than me. So if you want to go into it, I'll introduce you to a bunch of places. So I go back to LA, and he starts introducing me to different firms, Kidder, Goldman, Oppenheimer, whatever. I ended up getting offers, and I took Oppenheimer. And I'm basically an assistant to a senior broker who, when I did my first interview, that senior broker was on his honeymoon. And so the manager of the office, who's the one who interviewed me, said, there's this guy who I think might be interested in hiring you, but he's on his honeymoon. Can you come back next week and meet him? And that's what happened. And I met him, and he hired me. This was back when the business was transactional. So during trading hours, I would be doing whatever transactions needed to be done that he was telling me to do. In the afternoon, my job was cold call, try to build a business. One thing leads to another. I wasn't cut out for that. My boss decided the first time Joe Biden ran for president was back then, 84, 85, 86. This guy decided to take 1 year off to go work on Biden's campaign, a sabbatical. So he came to me and he said, I'm going to do this. You've got this under control. I want you to run my book. And he changed the way I was compensated from a salary to a piece of the action. And that caused my comp to almost triple. What happened was I would do the transactional stuff in the mornings. And in the afternoons, I started calling money managers. I wanted to talk to buy-side guys about why they owned whatever the stock was. Because I had this view about the way the business was set up and the incentives for sell-side research to recommend a transaction. Because back then, that's how they made their money. That led to me building a database of money managers who I thought were smart. And this went on for a couple of years. And then Oppenheimer figured out I was doing it and said, why don't we use that? Why don't we start a business with that? Which was my intention, but give them credit. The manager at the time had this idea, and I said, yeah, that'd be great. And so we started this business called the Oppenheimer Consulting Group. And that business was advising the brokers at the firm who had clients that had wealth. So we did that. We started it. I think we had 8 or 10 people, something like that. And it was good, but we were starting to outgrow Oppenheimer, and it was becoming political, and the New York people were starting to meddle too much. So fast forward 10 years at Oppenheimer, and it was time to leave. And the guy who had hired me at Oppenheimer had 3 or 4 years earlier moved to Bear. And he knew me, and I knew some of the Bear guys, and they had conversations about you should come to Bear Stearns and do this thing. And anyhow, it accelerated. And now I was frustrated at Oppenheimer and felt I really needed to do something different. The bottom line is, started talking to them, decided it's a good fit, decided we're going to move to Bear Stearns. We're going to call it the Bear Stearns Investment Consulting Group. That's what ICG is, by the way. And we start Bear Stearns Investment Consulting Group. And it was the same sort of model where we did manager research. And there was one guy who literally on the very first day that I was there comes downstairs, introduces himself to me, and says, I've got a client for you. First day. Now, he's never met me before. He has heard of me. It then turns out that his assistant, who now works for us today, went to college with me. In any case, I meet this guy. I love this guy. He was just the greatest. And he completely believed in us. And he started bringing us lots of business. And the business grew. I would say 5 years into being a Bear, we were there for 13 years. Some of our clients started saying, you really should leave and go start your own shop. And you know that old thing about if it ain't broke, don't fix it? It's like the Bear guys were great. Everything they said they were going to do, they did. Every promise they made, they kept. They didn't meddle. They didn't bother me. They provided legal. They provided compliance. They let me go around to the different branches and do road shows with their brokers so that the brokers would know that this service was available so that we could grow the business. They were great. The deal we had made was very fair. And people were saying, well, you should go. You'll make more money somewhere else. I said, of course I would, because obviously Bear's making money from us being here, but I've got to deal with them. And they've never broken a word of it. They've always kept their word. I'm not going to just say to a partner, you know what, thanks for the memories, but I'm going to leave you now after you've helped me get to here. So that's just not the right thing to do. Plus, there's no reason to do it. If it ain't broke, don't fix it. It eventually did break. Because in 2008, Bear went away, effectively. JP Morgan bought us. And then there was probably a 4 or 5 month period of seeing if we could stay at JP Morgan. JP Morgan wanted us to stay. They were great too. But we figured out that because they have this massive funds placement business, that business had conflicts with ICG. And when we figured it out, I went to the compliance people and I called our lawyers and said, isn't this a conflict? Isn't this a problem? And they go, yeah, it is. So I called the people I was dealing with at JP Morgan and said, look, guys, I keep trying to figure out if there's a way for us to stay here, but there's actually not. And I've checked with legal and compliance, and here are the problems. We couldn't stay and do what we were doing if they wanted to keep the funds placement business intact. We got to go. They were awesome. They said, take your time. There's no rush. Find your real estate. Get your new firm. Do everything you need to do. All good. Then, of course, the fourth quarter turns into the fourth quarter. You get to the end of the year, and it's a train wreck. And we're spending more time dealing with portfolios and clients and stuff, and not as much time as we needed to set up ICG Advisors. So the end of January, we're JP Morgan, Bear Stearns, and February 1, we're ICG Advisors. That was 15 years ago.
So when you started to go through this process all the way back to Oppenheimer and through Bear of looking for external managers, what did you learn along the way about what worked other than the premise, hey, if they're smart, that's probably a good thing?
Being smart is a good thing, but the problem with that as a screening criteria is that most people in the investment business are smart. They are. They may not be geniuses, and some are smarter than others, but there's not a lot of people that you would look at and say, that guy's an idiot. They're smart and they're ambitious, but that doesn't mean they can make money or raise money or control risk or even know how to control risk. It doesn't mean lots of things. It means they think they can, and they probably have good PowerPoint skills, and they can make a good pitch deck, and they're probably pretty good at speaking and gift of gab, and they can convince people. But there's a reason they say that most money managers don't beat the market, because most money managers don't beat the market, even though they're smart. And that's before you've got the last decade of zero interest rates that made it even harder to beat the market, because in a zero rate environment, there's more competition from the market itself, and security selection is less important because the rising tide lifts all boats. So it's not about are they smart? It's about what differentiates them, how easily can it be replicated, how quickly will it be replicated, how good is it when you adjust it for the kind of risk they take to get whatever the results are. Maybe the returns are 20% lower than the market and the risk is 80% less than the market. There can still be alpha there. And so what we're trying to assess is, do they have a process that we believe looking forward can generate alpha for our clients? Because the truth is, if you think the answer is no, then you should just buy the market. You're guaranteeing yourself no alpha, but over time, you'll get the market's return with the market's volatility. And so we're trying to find managers that we believe have something about them that gives them an advantage to generate alpha for the foreseeable future. And then our job is to stay on top of them and make sure that that continues to be true. And when we think it's not, it's time to say thanks, but we're going to move on now because there's too much competition in whatever you do, or your head of research left and this was a research-driven process and your new people don't have the chops that the old people, whatever the reasons are.
Where have you found those sources of advantage over time?
They tend to be smaller than larger. They're not managing hundreds of billions of dollars generally. So we spend way more of our time looking at smaller firms than we do at larger firms. Then, of course, small and large is all relative to the asset class in which they're investing. If you're a small cap equity manager, a large small cap equity manager might be a couple $1 billion, but that's a small large cap equity manager. It's adjusted for the marketplace in which they participate and what it is they're doing and the inefficiency of the market in which they're participating. But generally, they tend to be smaller. They tend to be independent. They always have real, identifiable risk control processes in place. At some point along the spectrum of doing the investment diligence, there's enough interest where we think there's really something there. And we start beginning the process of doing some of the operational diligence. And operational diligence can kill investment diligence. They can say there are these problems that they have to get fixed, or they won't fix these problems. And so that's the end of that.
What's ICG today?
80-ish clients. Most of them are taxpayers. A dozen are small and mid-sized institutions, museum, a hospital, school, things like that, but mostly families or people. I don't know what our AUM is, but it's probably between 7 and 8 billion, or approximately 27 employees.
How have you tackled the investment challenge for your clients?
We want to protect our clients. So we spend a lot of time with our clients understanding what it is they want and making sure that they understand that what they are saying they want, they really know what that means. Because the worst thing for clients is they get a portfolio that they're not comfortable with because it's too volatile, the strategies are too complex, and they don't understand them. Some of our clients don't understand the strategies they're in, but they don't care. But if they care, they need to understand it. And if they can't understand it, they're uncomfortable. And when you get uncomfortable, you start making decisions based on emotion rather than based on finance and economics. We're trying to make sure that when we build a portfolio for our clients, that it's really inside a framework that makes sense for them, both in terms of their own comfort level, but also that will deliver for them the returns that either they want because they just have a goal, or that they need. It's an endowment and they're giving away 5% a year. If you're giving away 5% a year and you want to have a perpetual endowment, you can't just earn 5% a year. Because first of all, you're not going to earn 5% every single year. You're going to have some years where you're up and some down, and you're going to average 5. But if you average just 5 and you're giving away 5, you're going to slowly lose purchasing power. So you really have to earn more than that. And then you have to factor in there's fees. Now, there aren't taxes for a foundation, but the point is we want to make sure that clients have objectives that they sign off on as comfortable for them, and we sign off on as achievable for them. And we'll actually give them what they really do need. That's a fair amount of the work we do in the beginning so that we have a higher probability of delivering a solution to clients that makes them happy.
Do you have a favorite story about the ups and downs of getting there with a particular client?
We have a family that's been a client for many years, approaching 30. I think we actually worked at Oppenheimer on the day they hired us, but that was maybe a month before we left Oppenheimer. So then they went all through Bear with us, and now they've been with us at ICG. And it's a healthy size family trust. They were talking about their long-term returns, and we're very focused on portfolio volatility. If you and I each have $1 million and we go invest it for the next 10 years or 15 years, and we both earn the same 10% per year, average return, and you do it with 20% vol and I do it with 10. But during that 10 or 15 years, neither one of us puts any more money in and we never take any money out. We just leave it alone. When you get to the end of the measuring period, we'll have the same amount of money because we both compounded at 10% a year. But if we both earn 10% a year and you do it with 20% vol and I do it with 10, and there's cash flows, I'm pulling money out because I have to pay taxes or I have to support the kids, or I'm adding money because I sold the business and putting money. If there's cash flows along the way, I'm going to have more dollars than you will if I compounded with half the vol. This client that I was referring to asked us about that recently, and the client basically wanted to understand the returns that they've gotten over time, which were maybe 1 or 1.5% per year better than that benchmark. but with a lot less volatility, less than half the vol. They wanted to understand what would have happened if we had instead just done the benchmark passively and rebalanced it every year. So I said, well, you have to make some assumptions. You have to make the assumption that whatever cash flows you had for the last 25 years, that you had them in this make-believe model. Whenever you gave us money, we have to add it to that. Whenever we took it away, we have to take it away. When we ran that number, it's huge. The differential was in the hundreds of millions of dollars. I knew it was going to be big. I didn't know how big. It was very eye-opening to them. And I did it because I said, I really want you to understand why volatility matters as much as it does. It doesn't matter a lot if you're talking about reducing vol from 20% to 18%. It'll help, but when you reduce it by half or 2/3, it makes a big difference. And how do you do that? By diversifying. But real diversification, not 5 long-only equity managers whose correlation to one another is 90. Real diversifying strategies that this zigs, that zags, and you rebalance.
I'd love to take that into how you've gone about investing on behalf of your clients. What are your thoughts on some of the other asset classes you participate in?
Well, we haven't had long-only investment-grade fixed income in client portfolios for probably more than the last 10 years, maybe the last 10 or 15 years. And if we had it, it was really short duration, almost extended duration cash type stuff, but no traditional investment grade bond portfolios. Or when I say no, I don't mean zero. Very, very little. But I didn't understand, why do you buy bonds? You want liquidity. Bonds give you liquidity. You want return. They weren't giving you return. And you want safety. They're not actually safe when they yield 2%. They run the risk of price compression when rates rise. And of course, the investment highway is littered with people who think they know what interest rates are going to do, and you don't know. What you do know is if I own a bond portfolio with duration and it's got a 2% average yield, I know when rates rise, that portfolio is going to go down. And people don't invest in bonds for that. Somebody who invests in the stock market, they don't like it when their portfolio is down 20%, but they know it can be. And that's the price of admission. Nobody invests in the bond market thinking they can be down 20%. They just don't do that. We're just now starting to really consider beginning to add some of that asset class back into portfolios and are pretty close to done with the work we're doing to identify the managers we'll use to put that in place for some of our clients where it's an appropriate allocation.
Have you thought about the whole alternative space? You hear more of the trajectory you've been on, that more private equity, more of this is coming to this high net worth channel. I'd love to get your experience and what you've done and what you're seeing more broadly.
Well, the interesting thing about it coming to that high net worth channel is how it gets there. If it gets there through aggregating vehicles, there are shops that are in the business of making private equity and other alternatives accessible to a universe of clients that are smaller than ours. A good chunk of the returns that our clients will get from that, they won't get, because the shop that's putting it together is taking it in fees and expenses to do it, and then the fees they charge to do it. So while it'll add some diversification to those clients' portfolios, I think they're probably going to be disappointed with the level of returns, but we'll see. But that aside, there's plenty of opportunity in the alternative world to make money. And I think in an environment where the risk-free rate is no longer zero, it's not going to be as easy for the S&P 500 passive Vanguard fund. It probably won't do as well, relatively speaking, over the next 5 to 10 years as it did over the last 5 to 10 years relative to good active managers. We believe that. We'll see.
Have you thought about private markets?
We like private markets, but we've been doing it for a long time. What makes markets attractive is the less competition there is, the more opportunity there is to eke out some excess return. And so as the private market world becomes more and more accepted, we'll probably start to see the excess returns diminish. If you look at the last several years, the illiquidity premium that's been paid has been overly generous. Should you really be able to earn as much more as you have been earning in private credit than you could in public credit? You should get a premium for the illiquidity, but should it be that much? I don't think so. We never underwrote it for it to be that juicy. It was. But right now, that spread goes away because the liquid markets are inflated, but you instantly see it in the liquid markets because risk-free rates are 5, not 0. Looking forward, we believe more return is going to need to come from less traditional space. If we're right, and the equity markets going forward are going to give us mid-single-digit compounded returns for the next 5 or 10 years, that's probably not enough return for many market participants. And it'll probably lead to the need to take dollars away from that asset class and put it somewhere, whether it's private markets or hedge fund world where there's liquidity, where they believe there's an opportunity to generate higher returns, either because security selection or the ability to short or whatever the reasons are that people convince themselves that somebody can do something that's better. If that's right, and the bond market's going to give you 4 or 5%, and you conclude you think the stock market's going to give you 5 or 6 or 7, and you're a foundation that gives only 5% a year, plus you've got some operating expenses to run your foundation, you probably have to do something about it. What are you going to do? Probably look to firms that have real chops in alternative investment work that can help you maybe reshape how your portfolio is constructed to give you a little more of that part of the solution to get your portfolio's results up to whatever you need.
When you look at those two categories, if you think about the hedge funds that you like investing in, what are the ones that you gravitate towards?
Well, there aren't a lot of them. There's managers that we think can deliver alpha. We're more on top of managers where the bar is higher. And the bar is higher when the fees are higher. They've really got to prove that it's worth paying a management fee and carry. Because I could just hire a long-only equity manager and pay whatever it is, 30 to 100 beeps, depending on who the manager is and what they do. There's a constant process, not like we're short-sighted, not like we make decisions based on one bad quarter, but when managers have a bad quarter, we want to understand why, but what we really want to understand is that they understand why, that they understand what went wrong, what they missed or didn't miss, or what they did or didn't do, because if they don't know, that's a problem.
So what are the types of answers that resonate for you and your team that give you the confidence to stay put?
When managers are going through a rough spell, we literally just did this last week with a manager we've had for a while who's going through a tough spell. And they're great. And they run liquid funds and private illiquid funds. And we invest in both. And the private illiquid funds have been really good. The liquid funds, the hedge fund structure, they've been okay, but it's not worth it. And I called the main guy and said, we're really thinking of leaving this, not that. We can't leave that anyhow. But that's good, so we don't want to leave. And we don't want to sell it in the secondary market. We're happy with it. But the hedge fund is like, there's better places for us to put the dollars when you factor in everything. We're thinking we're going to leave. And I just want to hear your thoughts. And his response was, we should show you what's in the book and explain our investment thesis on what we own. You should understand why we own these names and what we think the timing is. It's very painful to be with a manager whose performance is not great. I'm not talking about bad, just not great. And then you leave, and 3 months later, boom. Capitulation's a bad word in the investment business. So he said, we should explain this. I said, absolutely. We want to hear from you. So we did the Zoom meeting last week, and they took us through everything. And we finished, and we said, he's making a lot of sense. They're giving us rational reasons why that healthy move up is not far off. And we believe it. They have real, logical, direct reasons for the companies in their portfolio. They explain it. They tell us why it makes sense. Okay, let's give this a little more time. Because if it's wrong, we've had this juice isn't worth the squeeze return for another 6 months. Okay. But if they're right, it's meaningful. And the pain from our perspective of them being right and us being gone is much more than the pain of 6 more months of it was mediocre. So the answer to your question is we want managers to explain literally why do you own these positions and what's going to happen? And then we look to see if it's going to happen. These things that they're telling us, are these things happening or not? And if they are, they know their companies and their investment thesis is solid. Timing is, you can't know unless you're trading on inside information, and obviously that's not good.
So if you look out 6, 9 months, whatever it is with this manager, and they ended up being right. So you have this period of time with outside, then what?
That's a very good question. I even said, guys, I think the long-term point is that my view is that we've been with this manager for a while. They're not delivering enough results over time to make sticking around worth it. On the other hand, their portfolio is particularly depressed now. Selling it now is foolish. They have a thesis behind it. If it plays out, I say we use that as an opportunity to move on. But obviously, if it doesn't play out, then it's an easier decision. And then if it does play out, and it all works out exactly what they say is going to happen, we're going to look and say, oh, those guys are smart. They know what they're doing. That's great. Okay, but we already think that. That's why we're staying. But that doesn't mean we should stay for the next full cycle of this. There's other places those dollars can go where I think we would say we believe we can get a better impact in a client portfolio. So I guess we'll see. This dilemma goes on with every investment committee at every firm that does what we do.
How are you thinking about private equity?
We look at where managers mark their book and want to understand how are you carrying the values for whatever the companies are in your private equity portfolio. And there's nothing we can do about it other than question them. But what we can do is feel confidence in their realistic assessment of the value of what they own, or feel less than confident. If we feel really confident and they've put up good numbers, they've done a good job, and now they're going to raise their next fund, is it rational to think there's a good chance we'll re-up? Yes. Even if the results are good. If we're not comfortable with the way they mark their book, we just don't believe it. They're just basically faking it till they make it. And they do make it, so the results are good. There's a much less likely chance we're going to re-up. I was having an exchange with a different money manager today. I'll read you what this guy said. I still think the PE guys more broadly are delusional. They think their stuff is worth a lot more than the public markets are telling them. I do not get why they trust themselves more than the markets. Their assets are just not as good as the public ones, period. This is a hedge fund manager's opinion of, broadly speaking, the private equity world. And he's probably right to a certain extent, but he's not right across the board with everybody. Our private equity managers tend to be more sector-focused specialists like healthcare guys or finance markets or biotechnology that gets really complex and really requires sector expertise, not a jack of all trades. We do some private equity investing where it's more broadly defined and it's not just healthcare and not just, you name your thing, consumer, but we tend to like those more. Unless you're running gazillions of dollars, you've got to make those dollars count. And so you can't have multiple analysts in multiple different sectors, healthcare, consumer, technology, on and on and on. So you channel it into that specialization. It's also more rewarding because there is some satisfaction in identifying talent early. Everyone knows who Blackstone is. You don't need us to put you in the next Blackstone fund.
When you have this overriding interest for many of your clients of somewhat muted volatility through diversification, how do you think about venture capital risk, which has been such an important driver of return, but yet also has tremendous risk to it?
Even a conservative client can still have some venture in their portfolio, but they'll probably just have less. They'll probably just have a smaller bucket of that than they will of other things. Then a more aggressive client would have more. Now, does every client of ours have venture? No, of course not. Probably every single one of our clients has some long-only equity exposure. They must have some. They do. Most didn't have bonds for a long time. With exception, they didn't have those and they did have equities. But some clients have more real estate. Others have less. Generally speaking, taxable clients have more real estate than non-taxable for reasons that are probably logical. Clients who have larger illiquidity buckets, they don't need as much liquidity, will end up with more private equity, private credit, real estate, venture than clients who have smaller budgets. And some clients have bigger liquid budgets because they rely more on the portfolio, they spend it more, they need access to it more than others. We have some clients who almost never take money out of their portfolio. They just add to it. They make money doing whatever it is they do. And the portfolio, its liquidity is used to manage itself, not to fund operating or living. So it depends.
How do you think about being a good partner to your managers?
Being really straight with them. If we're expecting to add a big piece of capital or redeem something, we want to give them as much notice as we can. Now, sometimes you don't need to because what they do is so liquid and they're big and it doesn't matter, but it's still being a good partner. Managers appreciate information flow. So if we know that we are going to take a whole bunch of money away from some manager, the sooner we can tee that up for them, or add, by the way. We have a biotech manager who we just gave them a healthy chunk. We called them in advance and said, hey, we want to do this. We want to give you the heads up and make sure that that's all good. Not because they're closed or not closed, but they might have something to say about that. That's great. Or you know what? This is the wrong time. Hold off. And we want to work with them. We're pretty demanding about information flow. So while we want to be good partners and give them all that information, we want them to give us the information we're asking for. And we're not great with managers who have proprietary this and secret sauce that, and we don't share this. And that's like enough already.
What's the normal cadence of your communication with managers?
Anywhere from monthly to quarterly, depending on a whole host of variables. How much money we have with them, how easily we can track what they're doing. Like if it's a large cap value equity manager managing separate accounts and we can see exactly what's going on, we probably don't need to talk to them every month unless we just have questions because we can see everything. And if it's a biotechnology hedge fund and you can't see it and the markets are crazy, we might be talking to them more often. The written communication is quarterly. We send out a quarterly questionnaire that managers need to complete. Make sure they're on board. There was a manager that we interviewed last week, and they're very direct and said, you'll almost never get to talk to the portfolio manager. But if we get down the road and we're serious and we think we want to invest, are we going to get to talk to them? Are we going to get to come up and meet them ever? Or are you saying we're never going to see this guy and it's just like he's the Wizard of Oz and he's behind the curtain? That's not happening. I don't care how good the track record is, and I don't care how many smart investors invest with them. That doesn't fly. But people do it. I think some managers think that doing that somehow almost makes you want to invest with them more, like it's like you're special.
How have you worked on and developed the relationships with your clients?
When you have 100 clients or 80 clients or 150 clients, you can have a relationship with them. When you have 1,500 or 15,000 or 150,000 or whatever, you can't. We've got a pretty good ratio of investment professionals to clients. We just do. We naturally can speak with them. What we get paid to do is build their portfolios and manage their risk and manage their money. But we don't get paid to help them find a mortgage, but we help them find a mortgage. And we don't get paid to help them finance an airplane, but we do help them finance an airplane. And we don't get paid when they need to buy some insurance for their estate plans. But we understand insurance and we speak it. And so we can talk to their insurance people or find them insurance people to get them what they need. And we know what to ask. And those insurance people know that we know what to ask. So that whole game that goes on in the world of insurance doesn't happen with us. We don't get paid a penny for any of that, ever. And it matters to do those things. And I think the clients appreciate it. So there's a pretty healthy relationship. Some of our clients I talk to a lot, every day or every other day. Sometimes just for a joke or something, or for work. We have a client, I won't say who it is. I think they've been clients for 20 years. When we got hired by them, they met us. We speak to them on the phone when we need them, but we've never gone to their home state, and they had never come to our office in 7 years. 7 years into the relationship, they called to say they were coming to California. It's like, great. It's been a long time since I've seen you. I'd love to set up a time. When are you going to be here? I want to find time and have you come into the office and go over your portfolio and just catch up. And they said, oh, and the guy says to his wife, he's on the phone and he's yelling to her, I can hear her, what's your schedule? Jeff wants us to come in. And I said, weren't you calling me to come in? And he said, no, I was calling you to get restaurant recommendations. I'm like, you've been our client for 7 years. If you're going to be in Los Angeles, you have to come in. And they did. So my point is, we have clients that they almost never call. We call them because we need to do things. And then we have other clients who we talk to regularly. And it just depends on the client.
Where are you hoping the business goes from here?
I think more of the same. We don't know what our capacity limit is. And we imagine our capacity limit is more likely to be hit by the number of clients than the amount of dollars. Because I don't see us being the kind of firm that's going to be managing $200 billion. I'm exaggerating, but I'm trying to make a point. A lot of the managers we use, we couldn't even think about if we had to allocate huge sums of money. But if we were allocating $20 billion, we could do it. So would it be nice to be a $20 billion firm? Sure. As long as it's a $20 billion firm with 150 or 200 clients, not if it's a $20 billion firm with 7,000 clients. That's just not our business model and not something we'll ever, I don't know. Never say never, but that's pretty high up on the list of what I would say never to if I was going to ever say never.
How have you thought strategically about the business in a world where there feels like there's more consolidation coming?
Oh, there definitely is. We get calls all the time from shops. We actually entertained one of them. This guy called us, wanted to talk about combining. And we have this view that there probably are some consolidations, some combinations with other firms that really are synergistic, that actually us added on to some other firm, that 1 and 1 is more than 2, and that our clients would benefit from it. The research process would improve. Efficiencies would be realized. And if we ever find that, and we are simpatico in the way we view the world and the way we think about clients and taking care of them and allocating capital and that whole thing, and it was symbiotic, we would entertain it. But what we've generally found is, this is going to sound arrogant, and it's not meant to be, but I don't know how else to say it. Most of the times we've taken a look at that, what we've concluded is it's synergistic for them, but it's not adding anything for us. We have this research process. They don't, so now they'll get our research process. And they have one portfolio reporting system and we have another one. Okay, whatever. We could get that portfolio reporting system if we actually thought it was better. We haven't found synergy, but the calls we get, the emails we get, cold and warm, eventually that'll slow down. There's definitely a thing going on today where there's a lot of demand for firms in our business. And our firm is even more attractive than the average firm because of the clients you referred to. Obviously, I'm not going to talk about on a podcast, but you're familiar with some of them because you've met with some of them over the years.
Jeff, I'd love to ask you a couple closing questions before we wrap up. What is your favorite hobby or activity outside of work and family?
Probably golf.
What about it?
The camaraderie. It's not the actual golf because I'm not that good. But it's like being out with my friends or with my nephew or with whoever. It's the social aspect of being with people and golfing, and it's probably that.
What's one fact that most people don't know about you?
People who don't know me don't know that I'm the oldest of 6 kids and we're all 1 year apart. What is a fact that they don't know about me? I'm probably mushier than most people realize. People who know me well know that, but the average person probably doesn't know that.
What's your biggest pet peeve?
Stupidity. Drives me nuts. It does. There's this expression I've used for literally forever. I've got a very short, stupid fuse. Actually, I'd like it to lengthen a little. It just drives me nuts on stupidity. People who should know certain things, and it makes me crazy. That's the answer. I'm not necessarily proud of it, but it's the truth.
Which two people have had the biggest impact on your professional life?
Probably Art Laffer, the economist. He was the guy that told me to go to the money center bank. Because without that whole start, I really don't know what I would have done. I kind of wanted to go into politics, actually, but my wife-to-be was not going to have that. And she is my wife, and I've been married for 37 years. And the other one's probably, remember at the beginning of this, I told you I got to Bear Stearns, and this broker came downstairs on the very first day. His name was Joe Leach, and he did not know me. And he came, Joe Leach, and just went crazy with us. And the confidence he had in us, people follow. They lead by example. He was a big guy at Bear, and because he was throwing all this business at us, others started to do it. And so, I don't know, is it really right to say Joe would be number 2 or number 1? He's one of them for sure. God rest his soul. He passed away 12 or so years ago, but maybe those two.
What's the best advice you've ever received?
Breathe, meaning slow down, think before you speak, don't be reactionary, take your time, don't hit send. All of that is encapsulated in breathe. It's good advice.
All right, Jeff, last one. What life lesson have you learned that you wish you knew a lot earlier in life?
To breathe. Probably would have moved me further along sooner. I was a little too impatient. Patience is a virtue. I think it is an expression. I think it's a saying. It really is. I could use more of it, by the way, but I'm definitely better than I was when I started.
Well, Jeff, thanks so much for taking the time sharing this great story.
Sure. It was fun, Ted. Thanks.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.